Hello everyone. Today we are going to discuss about financial statements for partnership firms. In this topic, we will talk about the introduction to partnership, essential characteristics of a partnership deed, contents of partnership deed, profit and loss appropriation account, and the format of profit and loss account. So, let's start with the meaning of partnership. In partnership, two or more persons join hands to do a business. According to Section 4 of Partnership Act 1932, partnership is the relationship between two or more persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Moving on to the characteristics of partnership, it is an association of two or more persons. The persons entered into partnership must sign an agreement. Business must be carried on by all or any one of them acting for all. There should be a lawful business. And last one, no separate legal existence from its owners. Moving on to the next topic, that is partnership deed. To create a partnership, partners sign agreement which may be oral or written. But it is always better to have a written agreement to avoid future disputes. The document containing the terms of partnership as agreed by all partners is called partnership deed. It includes name of the firm, name and address of all the partners, place of the business, nature of business, duration of partnership, ratio in which profits are to be shared, capital contributed by partners, profit sharing ratio, and rules to be followed in admission, retirement, etc. Now, moving on to the rules applicable in the absence of partnership deed. The first rule regarding profit sharing ratio is profits and losses would be shared equally amongst partners. No interest on capital would be allowed to partners in the absence of partnership deed. No interest on drawings would be charged from partners. No salary or commission is to be allowed to partners. If a partner has provided any loan to the firm, he would be paid interest at the rate 6% per annum. This interest on loan is a charge against profits, that is, it is to be allowed even if there are losses to the firm. And lastly, a new partner can be admitted only with the consent of all the existing partners. Now, we will discuss about profit and loss appropriation account. This account is prepared after trading and profit and loss account. It is an extension of profit and loss account. The net profit of P&L account is transferred to P&L appropriation account. All the appropriations of partnership deed are recorded in this account. And lastly, the purpose of this account is to show the distribution of profit among partners. The transactions between the firms and partners are mainly shown in this account. Now, a question arises that what is the difference between P&L account and P&L appropriation account? P&L account is a statement that shows the quantum of surplus funds available to the entity at the end of financial period, whereas profit and loss appropriation account gives us detail about how the surplus that is shown in the P&L account is going to be spent. Profit and loss account is mandatory for all entities, that is, partnerships, companies, etc., while the appropriation account is usually prepared only by the partnership firms. P&L appropriation account usually gives details about how the surplus money is going to be spent, means how much of it goes to each partner, how much is to be invested in capital expenditure, and how much to be used as earmarked reserves, etc. Now let's have a look at the format of P&L appropriation account. As we can see, there are two sides of the account, that is left and right side, because it is a T-shaped account. In case of any loss brought forward from last year, that will be on the to side, that is left side, and in case of any profit brought forward from last year, it will be on buy side, that is credit side. Starting with net loss as per P&L account, which will be shown on to side, and if in case it is net profit, it will be shown on right side. Now we'll start with the items on left side, that is all the expenditures. 2. Interest on capital. 2. Salaries to partners. 2. Fee, bonus, commission to partners. to amount transferred to reserves, and on the right side we will find all the sources of incomes, that is by interest on drawings, by fines charged from partners, and after it we will find the balancing figure. Now if it is on the left side, it will be partners capital account, that is share of profits, and in case of right side it will be partners capital account losses. So now these losses and profits will be divided in their profit sharing ratio. Let's take an example. On 1st January 2016, Allen and Bravo entered into partnership contributing 2 lakh and 3 lakh dollars respectively and sharing profits in the ratio of 3:2. Bravo is to be allowed a salary of $600 per month with effect from 1st March. Bravo is to be allowed a salary of $600 per month with effect from 1st March. Interest on capital is to be allowed at 10% per annum. 5% interest is to be charged on the drawings. During the year, Allen withdrew $12,000 and Bravo $20,000. Interest being Allen $200 and Bravo $400. Allen further introduced $1 lakh as capital on 30th June. Profit in 2010 before making any of the above adjustments was $96,000. Show how the profit is to be distributed. Now, let's have a look at the solution. It will start with profit and loss appropriation account for the year ending 31st December 2016. As we have already discussed, it is a T-shaped account, so it will be having two sides, that is left and right side. On the right side, we will write balance brought down as it is given in the question as $96,000. On the to side, we will write salary to Bravo, that is $600, and it will be for 10 months, that is from March till December. So 600 into 10, that becomes $6,000. To interest on capital, that is 10% on 2 lakh, that becomes 20,000, and again 10% on additional capital brought by Allen, that is $1 lakh. Now this additional capital was brought on 30th of June. So the interest will be paid for remaining months, that is July, August, September, October, November, December. That comes to be 6 months. So the interest will be 10% into 1 lakh into 6 by 12. That becomes $5,000. So the total of interest on capital for Allen will be $25,000 and for Bravo will be 3 lakh into 10%, that is $30,000. And on buy side we will write interest on drawings that has been given in the question, that is $200 for Allen and $400 for Bravo. That comes to be $600. Now after calculating the difference, we found out that the to side is falling short by $35,600. This means it is the profit for both of the partners. Now this profit will be divided among them in the ratio, that is 3:2. So we will divide 35,600 by 5 and multiply it by 3 in order to calculate the profit share of Allen. That comes to be $21,360, and for Bravo it will be $14,240. So at the end we will balance both the sides by writing the total, that is $96,600 on both sides. I hope now you will be clear with how to make P&L appropriation account. Thank you.